Good afternoon, everyone. It's June 3rd, 2026. It's another beautiful Wednesday afternoon here in the Midwest. For those of us that don't have to go to the office today, it's nice to be outside. People are walking their dogs, kids are playing baseball at the park. I'm able to get in the car and go to the store if I want something, and this is a good thing right now because this may all change here in the not too distant future. We were warned last week by some big oil execs at Chevron and Exxon that we are approaching dangerously low levels of commercial inventories. So what that means is that when the crude oil drops below a certain level, that the facilities don't really function as well as they normally do because the levels have now dropped to where there's less pressure in the pipes. And this makes the process of transporting and storing the crude very, very difficult. So the minimum in Cushing is about 20 million barrels. And according to my calculations, we have run out of usable crude in the Cushing facility. So when I turned on my clock, it was negative several hours. We did get the EIA reports this morning for the actual figures. We're going to look at those in a little bit. And at the current draw rate, my calculations say that the Cushing facility is now below its operational minimum. That is a big deal. The commercial storage minimums are calculated to be around 375 million. So we're at about 430. So we're approaching those. And at the current draw rates, those are going to be approaching the dangerous level in about 5 or 6 weeks. That would coincide with the Exxon and Chevron CEO warning. So this is going to get very, very interesting very, very quickly. We did get employment data this morning. So there was an addition of 122,000 jobs on the ADP report. We're going to look at that as well. And what I find very interesting about this particular environment that we live in, which is a semi-permanent state of cognitive dissonance, is that we're able to make almost anything sound awesome, no matter what it is. We're even able to make the most scary and troubling and unsettling sorts of facts that come out on the news headlines. We're somehow able to put a positive spin on those as well. We'll get to the war headlines later. First, we are going to address the employment report. So, the employment report is Groundhog AI appointed to oversee the situation effective immediately. 122,000 jobs is the strongest hiring in 16 months. Therefore, everything is fixed, he claims. May 2026 ADP report created 122,000 jobs. He's got his cup here that he, just made. Jobs are awesome. Trust me. He's got a little button here if, he needs to reset expectations. It says right here, lower expectations, beat them, declare victory. So I guess AI has got the formula for pushing up and pumping up the numbers. Lower expectations, beat expectations, declare victory, ignore history, blame the participation rate, and repeat as necessary. So that puts the narrative strength, at the maximum. Markets, of course, are on all-time highs. We're always on the all-time high. Lately, it seems that every day we come in here, it's another all-time high. The Cushing reality check is empty. That's not part of the employment report, so we're not concerned with that. We're not really concerned with the labor force participation rate, which has been steadily declining for years because nobody really seems interested in working anyway. If we fact check this, is 122,000 jobs historically strong? Yes. Compared to what? It says stop asking questions. Is the labor market booming? Yes. Define booming. AI says you wouldn't understand. Any contradictions? None detected. Absolutely everything is awesome. Making employment great again. Incredible. Absolutely incredible. So when we look at the chart, following a shockingly strong JOLTS report, ADP just reported a stronger than expected rise in jobs added in May. ADP says 122,000 jobs were added in May, better than the 120,000 expected, and the biggest monthly addition since January 2025. That sounds great, doesn't it? Well, look at these levels here. These levels are pathetic compared to the job growth that was actually occurring in 2021 and in 2022. You can see that we are adding a lot more jobs back then, a lot more. So these increases, better than expected and biggest monthly addition, yeah, because our job growth has been basically nothing for almost 2 years. So of course, this looks great. If I get the data together, I gave GPT a prompt, add the fact that 122K is far below the historical norms and put numbers on it. It says, if you're trying to build the headline versus reality table, that's me, Mr. Doom and Gloom, always looking at reality, spoiling everybody's, day. I would absolutely add historical context because that's where the best in 16 months claims start to look less impressive. Story one. I had 2 columns generated for this. We have one story that's being told, and then there's another story that's being told at the same time. And one story is being told at an exceptionally loud volume, while the other story I have to dig and dig and dig to find the facts of. May 26, ADP, 122,000 jobs, best in 16 months. Structural reality, 2014 to 2019 expansion. Typically, the monthly payroll growth was often 180,000 to 250,000, meaning the 122 is roughly 30 to 50% below what was considered normal during much of the prior expansion. So during an expansion, these are the numbers that we usually see during an expansion, couple 100,000 jobs. We're about half of that. Strongest hiring in 16 months. It is only the strongest hiring because the previous 16 months were unusually weak, with many reports in the 60 to 110K range. Okay, that doesn't sound very good, now does it? Hiring beat expectations. Beating a weak forecast does not make the number historically strong. 122K print would have been viewed as a mediocre add during much of the 2010s expansion. Labor market showing momentum. Well, it's true. It is slightly going up. There is some momentum here. I'll give them that. Reuters notes economists still describe the labor market as low hire, low fire, meaning stable rather than booming. Okay. Unemployment remains relatively stable. Household survey employment has fallen by roughly 1.37 million during 2026. Labor force participation has declined and workforce growth has weakened. I heard a statistic the other day that 1 in 3 American able-bodied males do not have a job. 1 in 3. That would be a 33% unemployment rate. Market interprets the report as economic resilience. Really? 2025 saw approximately 1.2 million announced layoffs, one of the biggest highly layoff years since the pandemic, while hiring plans remain historically weak. So if you normalize everything to the 2014-2019 period, typical strong month, 200,000 plus jobs. May 2026, ADP 122,000. Difference from a 200,000 baseline, 39%. Difference from a 250,000 baseline, 51%. So the honest framing is not the labor market is booming. It's closer to the labor market stopped getting worse, and the strongest month in 16 months is still roughly 40 to 50% below what was considered normal job growth during much of the last expansion. We take something that really isn't that good and we make it sound absolutely awesome and sensational. Let's go to the crude oil situation. Another dose of reality that nobody wants to acknowledge. The Strait of Hormuz has been closed for 95 days, 19 hours, 21 minutes, and 32 seconds. We've lost 1.3 billion barrels of crude oil since the closure. 13.3% of the world's supply effectively destroyed and removed from circulation. This is 2.94 times the worst crisis in history of the 1973 oil embargo. Now, why is this situation extraordinarily dangerous? Why do I keep pounding the table on just how unpredictable it could get? Because there's really no analog. I wasn't even here yet in 1973. I didn't get here till a few years later. So I've never seen a real oil crisis. And lots of other people have never seen a real oil crisis either. So when the CEOs come out and they're talking about shortages, nobody really understands what a shortage actually is because we've never experienced a real shortage. Here's Cushing. The Cushing clock ran out and I had to allow negative values to come through now. So it's probably below its 20 million barrel operational minimum. And that means they're going to have to pull the crude oil from somewhere to refill the facility. The facility cannot stay empty for very long. There will be damage to the facility if it remains below the operational minimum for too long. So that they're going to have to do something about this. The commercial clock is calculating at about 67 days left until it hits its operational minimum of about 375. The 4-week draw average on commercials is 5.62. The SPR has about 150 some odd days until it hits its operational minimum of 150. That's actually a statutory floor. By U.S. law, it's not allowed to go below that. There's about 200 barrels remaining, and it's drawing at about 8.9 million barrels per week on a 4-week average. It can draw 4.4 million a day at the max rate. So that's about 20 million it could draw max over the course of a week to 25 million. Total SPR draw since the war started, 58. We still have vessel traffic at 5%, and the IEA coordinated release of 400 million is in progress right now. So here are the updated metrics. We can see that here's the statutory minimum right here. I've got the red line here. Come back on so you guys can see me. Let's read along. We're 75.4% above the floor. We've got 349 in there. We started with 415. Distillate stocks, 101 million barrels, down 11% versus the 5-year average. We have commercial crude. I've got the minimum here marked in red at 375. So we're about 60 million above there. So at the current rate, it's going to be at the minimum in about 6 or 7 weeks. And that coincides with what the oil execs indicated last week on Bloomberg, I think. And I was really surprised to see that on Bloomberg because you usually do not hear stuff like that. Once again, this is not something that anybody really has any idea how it's going to play out. And the extreme optimism in the market is extraordinarily reckless and dangerous, in my professional opinion. And gasoline stocks 213, down 6% versus the 5-year average. There was actually a little bit of a build in distillates and gasoline. Europe's running out of jet fuel, however. So if this were the European distillates, that they would be looking much worse. Maybe I'll add that later. Average SPR draw per week was 8.9. Average gasoline draw per week 1.2. We've got gasoline demand at 8.9 billion barrels per day, and the average 4-week demand is still at around 20. So the demand has not changed. The world is still demanding energy at the same rate. The prices have not risen high enough in order to encourage demand destruction. This is simply further delaying the inevitable. The signal should have been sent to the market 3 months ago. There would have been a massive price spike and the world could start adjusting for the coming shortage. Because the crude oil has remained level through pretty much that entire time after elevating briefly on the headline that the war started, the market is not able to generate the signal that it desperately needs so that the impact of this crisis is softened in the future. We are going to hit the brick wall going at the maximum terminal velocity at this rate. The surprise effect is going to be so strong and so traumatic that we may just descend into a state of absolute chaos and pandemonium. Well, we shall see, but it's not looking too good. The market, of course, continues to operate under the notion that everything is great and AI is going to solve all of our problems. Maybe AI will figure out how to 3D print gasoline and then problem solved, right? NASDAQ on the all-time high hit another record at 30,800. We've come off a couple hundred points since then. We could see that from the price action that we got smoked right on the open after hitting the high, and we've basically been chopping around ever since. The market's not really doing anything. It's in a drift. It just keeps drifting and drifting and drifting, and the AI headlines keep coming in, and the optimism, keeps being pumped, and the war is getting worse and worse and worse. There were more missiles, more drones, more attacks, more escalation all night long, all over the media. Market don't care. Crude oil did catch somewhat of a bid on the news. So the crude oil has been slightly elevated all session. We're currently at 96. So if we look at the daily chart of crude is now starting to turn back up. So even though crude went down and now crude's starting to go back up, the market is still in a complete full-blown state of euphoria, and people are still buying tech stocks. My guess is that this is just going to persist until the cold hard reality comes to pass that we may just run out of crude oil and gasoline for a little while. And if that happens, the system will be rudely interrupted and it will be forced to acknowledge reality. And we're so good at avoiding reality up until this point, I'm not too sure how that's going to play out. The S&P is starting to actually come off a little bit. So the S&P is actually starting to wake up a little bit more than the NASDAQ. The NASDAQ is, obviously completely oblivious to what's happening. It thinks that it's invincible, that, physics don't matter. I guarantee you that physics are going to matter eventually. They're just not really mattering too much right now. So we'll see what happens for the rest of the session. It's about 2:30. We've got about 30 minutes to go. We'll see how trading closes out the day. And tomorrow is Thursday. So Thursday is usually an interesting and usually a more volatile week because the weekend is about to come up and there is some weekend risk going into the market with the escalation of war. The peace talk headlines are having less and less and less of an effect. So the war is going to probably keep escalating and we're going to get even more military action over the weekend because that's usually when the most military action is conducted while the market's closed. So the investors may want to do something that they have not done up until this point, which is to actually hedge a little bit so that if something really catastrophic does happen, that they're not completely exposed. But according to recent figures, hedges are completely obsolete and dead, and nobody is willing to purchase any downside protection. They've gone all in on the upside and calls. Nobody has any available ammunition left to hedge or protect with put options. So the skew is the highest that it's ever been in years. I think Goldman put out a report on the volatility skew being just at completely obnoxious levels. So maybe we'll get to some more of those tomorrow. I'm looking for some type of risk off event, like even just a little risk off event. And that little risk off event could be the catalyst for a bigger risk off event, because when this thing actually gets going, it's been going up now so hard and so fast with no pullback whatsoever that any little disturbance to this thing could create some serious problems. And then, of course, we're going to have to get Groundhog AI back in here to optimize the scenario and basically prevent the market from going down. Because if the market goes down at all in the current state that it's in, it may go down a whole lot as everybody figures out, wait a minute, maybe things just aren't as good as we would like to think. So until tomorrow, you guys take care. Good luck, and definitely make some preparations for what's about to happen, because if the bomb drops that we all of a sudden have no gasoline available for deliveries, shipments, and trips to the store, that's going to make everything interesting real fast. So until tomorrow, I look forward to seeing you on the next one.